Dear students, coming back to financial management, capital budgeting portion, where we had already gone through discounting techniques in the last video clips. Discounting techniques we had covered: discounted payback method, net present value method, profitability index, and terminal value method. We had also gone through non-discounting techniques, payback and accounting rate of return or average rate of return. So the only portion balance which is left in capital budgeting is internal rate of return method, which I will be dealing today. This problem is lengthy in case of internal rate of return. The steps involved are lengthy. So sometimes one video clip which is covering 17 minutes when we are taking in mobile phone will not be enough. That video clip will be continued in the next video clip if the problem is incomplete in the first video. So let us check the internal rate of return. See, what is internal rate of return? It is the return expected by any company. You had gone through in the discounted payback method, net present value method, profitability index and terminal value. All these methods you had gone through something called cost of capital, which is the discounting factor we use. In this method, this cost of capital, you see here the acceptance rule of internal rate of return. It is mentioned if R is greater than the cost of capital, you have to accept the project. KO is cost of capital, you know well now. R is less than the cost of capital, you have to reject the project. And if it R is equal to cost of capital, K or KO, both we could mention. R is equal to cost of capital, the project decision will be indifferent, means they could accept or not accept the project. So what is this R? R is the internal rate of return. It is the discount rate which equates the aggregate present value of investments, cash inflow, with the initial investments or cash outflow, thereby causing NPV 0. This is technical jargon definition, but you could see this definition when I am sending the scanned copy. But let us check how we could directly get into the problem, understand the meaning of R. Anyway, it is the R, finding out R at a particular point of time, finding out the internal rate of return will cause the net present value 0. Okay, let us see. Two types of problems are there. First problem is with regular cash inflow, and the second problem I will be dealing with irregular cash inflow. Unlike the other methods, other discounting techniques, here the rate of or cost of capital will not be given. That is the peculiarity of this project, this problem. And the cost of overall cost of capital will not be given. At the same time, the internal rate of return will not overall cost of capital, the discounting rate will not be given. And here we have to find out IRR, internal rate of return. Internal rate of return is found out using various steps. Let us check. Okay, a project cost, this is a problem with regular cash inflow. A project costs 36,000 rupees and it's expected to generate cash inflow of 11,200. So CFAT is given 11,200 every year annually for 5 years, and the initial investment is 36,000. Its question is very simple. Calculate its IRR, and they had asked if K is equal to 15%, that is cost of capital is equal to 15%, comment about its feasibility. That's the question. So we have to find out the IRR or internal rate of return, which is denoted by R, and check whether the internal rate of return is greater than KO or less than KO or equal to KO. So those are the informations given. Initial cash inflow is 36,000 and the CFAT, cash flow after tax for the next 5 years is 11,200. So the step 1 is you have to first find out the payback period. This we had already studied under the non-discounting technique. here, as it is not a non-discounting technique problem or payback period problem, here it is mentioned step 1, calculate fake payback period. We are using the term fake payback period because this is for some other purpose we are now finding out, not the actual payback period we are finding out. So what is it? Initial investment, you know the equation, initial investment divided by constant annual cash flow after tax is the equation which we had studied under the non-discounting technique payback method. So that formula we are applying here. Initial investment 36,000 divided by 11,200 CFAT, regular cash inflow after tax. We will get the figure 3.214 years. Actually it is years. Okay, so 3.214. So that is the first step which we use. Now we have to find out, that is the second step, where this 3.214, okay, very important point, where this 3.214 lies in the present value of annuity of rupee 1 table. Make it very clear why we are using, it's a single amount, no? So we are finding out the present value of annuity of rupee 1 table. It is the, in the sense I will make it very clear, that is the inflow is regular 11,200 same. So we are using the table annuity. I told regular cash inflow we have to use the table present value of annuity table. And what we are doing, this is, you could see in the IM Pandey textbook, you could see the present value annuity table, table D. Okay, table D. We have to, what we have to do, this fake payback period figure which we got in the first step 3.214, where it lies in the present value of annuity of rupee 1 table. How we will do that thing? We have to take this figure, and what is the number of years? It is the inflow is for 5 years, isn't it? So 5 years, taking the period 5 years, where this 3.214 lies, that is what we are going to check. Okay, this taking this 5 years, this 3.214 lies, you could see the interest rate here and all. No, you have to check every 5 years. First easy way is that you check where 3.24 comes. See, up to 10% we won't get 3.214. So we are going to next table, which is continued. Present value of annuity rupee 1 at a different interest, it is continued. So again 5th year we are taking and going to 3.214. This 3.214, you see it lies between we will get the value at the 5 year at 16%. 16% is 3.274. 18% is 3.127, which we cannot take because we will require the figure 3.214. And in the IM Pandey textbook, the biggest problem is that 17% is not given, where we have to take it from different textbook or download the present value of annuity rupee 1 table and check out what is the value for 17%. 17% it will come around 3.199. In the IM Pandey textbook it is not given, I am writing it here. You could see in IM Pandey's textbook, you could see that in IM Pandey's textbook the table continuation of present value of annuity is after 10% it is 12, then 14, then 16. So these even numbers only had been given. Odd numbers is not given in the IM Pandey textbook. Odd numbers interest rate is not given in the IM Pandey textbook. So what we have to do? 3.199 is the value. So what is the thing which you are doing? We are taking this 3.214 fake annuity, fake payback period, and finding out using present value of rupee 1 annuity where this 3.214 lies in the 5th year. Where it lies between 16 and 17%. So that is the second step. So we are writing here. What we write in the second step, we will write it lies this amount 3.214 percent value closest factor. We are taking closest here we are taking closest factor. This 3.214 lies between 16 and 17 percentage. Now the third process. After finding out the 16 and 17 percentage, you are writing the present value factor of 16 percentage here 3.274 and 17 percentage 3.199. Both we are writing here. See, the meaning is that, make it very clear, this 3.214 fake payback period lies between 16 and 17 percentage of present value of rupee 1 annuity table, where the present value factors both we are taking. We are taking a note. Okay. So that is the second step. Third step is we have to apply interpolation. Okay, you have to make very clear this term, especially people who are not thorough with maths concept or statistics concept, who are not with a mathematical background. You should understand in a simple term what is interpolation. Why we are first, before getting into interpolation, I will explain why we are doing all these things. See, the name itself, it is clear. Internal rate of return means the company's investment, in this case company's investment is 36,000 and the return in figure is and the amount we are getting is 11,200. Now we are checking using discounting technique whether this return in percentage is correct or not, whether it is greater than cost of capital, whether it is less than cost of capital, whether it is equal to cost of capital. We are checking and finding out the feasibility of the project. That is why we want to know the exact return. We cannot take in blunt 16% or 17% as though the amount is nearby. We want to know the exact percentage in decimals. So that is why it lies between 16 and 17 percentage. Means it may be the internal rate of return may be from 16.1 percentage to 16.9 percentage, in between somewhere else. So if a figure is in between two different figures, or else if we do not know a figure which is in between 16 percentage and 17 percentage, again I will repeat, if we know the two values, that is 16 percentage and 17 percentage, and we do not know a value, the unknown value within these two known values we have to find out. Okay, I will make it very clear. The internal rate of return lies between 16 and 17 percentage. The 16 and 17 percentage are the known values. So if we want to find out an unknown value which lies between two decimal point or which lies between 2 points, we have to use the mathematical tool or mathematical field of numerical analysis which is called as interpolation. It's a mathematical tool or statistical tool. So what is interpolation? Interpolation is the process of estimation of unknown value within the two known values in the sequence of values used commonly in statistics. So when we have two figures with us which are the known values and we want to estimate or find out an unknown value which lies between these two known values, that method is called as interpolation. This interpolation is used only in internal rate of return method. There is one more method like interpolation which is called as extrapolation. What is extrapolation? Extrapolation helps in calculating the unknown values beyond the given data points. If we have a parameter, that is 17 is the parameter here. Beyond that point, if anything we want to know, we will use extrapolation. But this extrapolation is not we are going to study under the capital budgeting, so I am not explaining it. But mathematical certain basics you want to study here. So interpolation is what? Interpolation is the mathematical field of numerical analysis which we use for finding out an unknown value from the known two values. There are actually various methods of interpolation like graphic methods, algebraic method, etc. In graphic methods, it will be in various forms. Linear method is there, polynomial method is there, and spline method is there. And algebraic method, we have binomial expansion, Newton's method, Lagrange method, parabolic curve method, etc. Whereas Newton's method, again we will classify it as advanced difference method, guess backward method, guess forward method, dividend difference method, like that. So interpolation is a wide area which is used in mathematical field of numerical analysis. So these three steps you understand now. Step 3, the continuation of the problem will be explained in the next video clip, as the time limit for video clip is exceeded, which is 17 minutes. So thank you. Look into the next video for the continuation of the problem explanation. Thank you.